Hi, and welcome back to Her Path to Profit. We are so glad that you joined us today. If this is your first time listening, welcome. I'm your host, Jennifer Engle, CPA, business owner, running enthusiast, dog mom, and founder of Her Tax and Accounting GPS, where our mission is to help women business owners take back their time so that they can grow their businesses and reach the lifestyle and goals that they set out to achieve. In today's episode, we are going to be digging into a topic that has the power to transform how you manage your money. What type of expenses should you be tracking in your business, and why does it matter? If you've ever looked at your profit and loss statement and wondered why your bank balance doesn't match what you see on paper, or if you're just not sure if you're spending too much or too little on certain parts of your business, this episode is for you. Last week, we talked about revenue drivers and how important it is to know what actions drive money into your business. This week, we're going to be flipping the script and talking about what's going out, your expenses. Because understanding your expenses isn't just about bookkeeping or taxes, it's about understanding your profitability and making better decisions. So let's get started. So let's start with understanding your expense categories. Now, you might be thinking, aren't all expenses the same? They're just money going out, right? Not quite. There are three main types of expenses we want to track and understand as business owners: cost of goods sold, operating expenses, and other expenses. Each of these are going to play a different role in your business, and tracking them properly is going to help you to understand where your money is going, make smarter pricing decisions, and know when it's time to cut back or scale up. So we're going to start with cost of goods sold, or COGS as we often call it. COGS are the direct costs involved in delivering your product or service. So if you sell a physical product, this could include things like the cost to purchase or manufacture the item, shipping and freight. If you offer services, it could be things like materials that you use on a job, labor from contractors who are directly performing the client work, or software tools that are used specifically for the client project. And here's why cost of goods sold is important. It's going to tell you how much it costs you to deliver your product or service. So when you subtract your COGS from your total sales, you're going to get your gross profit. And when you divide your gross profit by your revenue, this ultimately gives you your gross profit margin, which is a key performance indicator that's going to show how efficiently you're delivering what you sell. Let's say your gross profit margin is 50% and your industry average is 65%. That could mean that you're paying too much for your supplies, or maybe you're not charging enough, or maybe you're not using your team as efficiently as your competitors. You really want to try to push to be at that 65% gross profit margin so you're in line with where your competitors are. And then understanding your COGS is going to help you to price your offerings properly, stay aligned with the industry benchmarks, and help you to predict profitability as your business grows, which is super important. And as your sales grow, your cost of goods sold is likely going to grow with it. But ideally, your gross profit margin, so that 50% or 65% we were talking about earlier, is going to stay steady. And that consistency is what's going to make it easier for us to plan and scale your business. Next up, we are going to talk about your operating expenses. Those are the day-to-day costs of just keeping your business running. These are the indirect expenses that aren't directly tied to a specific product or client, but they are essential to your operations and running your business. So think rent for your office or your warehouse, software subscriptions that are not used to provide the service to your client, your salary and employee wages of your office staff, your marketing costs, your insurance, all the things that are not directly tied to delivering the service to your client. However, they are necessary to run your business. Operating expenses, they are often more fixed or semi-fixed. They don't necessarily go up when your sales go up, which means that if you grow your revenue but keep these costs steady, your profitability should increase. So let's break this down with an example. In year one, let's say you have $500,000 in sales and your cost of goods sold is $250,000, resulting in a gross profit of $250,000. And then let's say your operating expenses are $100,000. That's going to leave you a net profit of $150,000. 500 minus 250 of cost of goods sold minus the 100,000 in operating expenses is going to give us a net profit of 150,000. Now in year 2, let's say we increase your sales to $1 million. So we doubled your sales, which meant your cost of goods sold also doubled, but they stayed at the 50% margin. So your cost of goods sold is now 500,000. So then your gross profit is also 500,000. 1 million in sales minus 500,000 cost of goods sold leaves you 500,000 of gross profit. And then let's say your operating expenses, those only went up by 10%. So they went from 100,000 to 110,000. Now your net profit is 390,000. So you increased your sales and your cost of goods sold, but maintained that gross profit margin and maintained your operating expenses. So you ended up with more profitability or more dollars in your pocket. You went from 150,000 to 390,000. That is a huge jump in profit, even though your operating expenses barely changed. This is the beauty of understanding your expense categories. You get to see where your growth is really coming from. If you lump everything together, you can't tell if your problem is in your pricing or maybe you're overspending on the cost of goods to produce your product, or maybe you're overspending on your operating expenses, or maybe you have inefficiencies within your team. You could really dive deep into these different areas if you're tracking these categories correctly. So when you separate cost of goods sold from operating expenses, you can pinpoint exactly should be fixed. Now let's talk about a third category, other expenses, which often get overlooked. These are going to include interest on loans, depreciation on equipment, amortization of intangible assets, such as like loan points or something like that, and income taxes. Why are we tracking these separately? Because they usually aren't tied to how well your business is actually operating on a day-to-day basis. They may result from a one-time decision or investment like buying equipment or taking out a loan. And these costs are often excluded when evaluating the value or profitability of your operations. For example, when someone is looking to buy your business, they often focus on your EBITDA, your earnings before interest, taxes, depreciation, amortization, because they really care about how profitable your operations are. And they likely are not going to have the same depreciation, interest, and taxes that you have. Understanding these numbers will help you to see how your financing decisions impact your bottom line, understand which expenses are temporary versus recurring, and help you make smart investment and growth decisions about your business. So now, why does this all matter? At the end of the day, tracking and categorizing your expenses is going to help you take back control of your business. It's going to empower you to make confident decisions, spot red flags early, plan for growth, and increase profitability. If you're not sure where your money is going, how can you ever make it work for you? It doesn't have to be complicated. You can literally just start by breaking your expenses into the three categories we just talked about: cost of goods sold, operating expenses, and other. You don't need to get into the weeds to break that down further, even though you could. Just start high level. Then start just reviewing these monthly. Start tracking them. See how they're trending. Make sure they're trending in the right direction. If they're not, ask yourself those questions of why. And asking, are these expenses aligned with where I want my business to go? So now that you have a clear picture of how your business expenses work and why they matter, are you ready to take the next step? If managing your numbers still feels overwhelming or you're not sure if you are reading them correctly, let's talk. You don't have to figure it out alone. Book a free discovery call with us at hertaxgps.com. Whether it's building better financial systems, interpreting your numbers, or putting a growth plan in place, we are here to support you. And as always, don't forget to like, share, and subscribe to HerPath to Profit so you never miss an episode. If you found today's content helpful, please take a moment to leave a review. It helps other women business owners find this show and grow alongside us. Until next time, I'm Jennifer Engle, helping you ditch the chaos, chase the clarity, and walk your own path to profit.